Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The stock markets tried to set new highs and energy prices are soaring. He also takes a look at commodities. Ed Steer from edsteergoldandsilver.com runs down the commitment of trader numbers for the precious metals. He says reading those stats and understanding them is a lot harder than many people think. Eric Haddock, CEO of InsideTrackTrading.com, comments on the various cycles that could be driving interest rates, currencies, gold, oil, food, and other prices. He also warns we're at the start of a 40-year conflict or war cycle. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money.
Good to be with you, Jim.
Well, after a bit of a shaky week last week, it looks like the stock markets are trying to set new highs again.
Yeah, it is. I mean, it was a week ago that we got a good oversold low in the S&P and in the Russell 2000. And, I thought, it's a little early to be putting in the low, but the price levels were good. We were at the 50-day moving average, which was an ideal support area. The relative strength indices were oversold enough for a bounce, and I thought we'd get maybe a day or two and then come back down and retest the lows. And surprise, surprise, it was, what do we got here? 5 straight days on the upside on the S&P and 4 on most of the other indices. So, the Fed and the easy money people, here you got the banks reporting decent numbers as far as their reserves are concerned, so it's only a matter of time before they can start to do buybacks and maybe increase some dividends. So banks and energies pretty much leading the way right now. And, that will take us into what is the normal summer high in a post-presidential year. So thinking that maybe the hiccup of a week ago was what we've got for now. The next one ideally would come with a correction sometime in the second half of July, and we'll see how deep that one is. We've got some technical parameters we'll look for at the time. And for now, the trend is still up, and you just look to see which sectors are working best at any given time.
How did gold do?
Gold and silver have stabilized, and we got some really good signals here at the bottom of the gold market a week ago. Had a decent bounce, saying at a $15 bounce off the bottom, but there's really been no real power coming off this low. Currencies. U.S. dollar really hasn't done much to help the gold market out. So, I still think that from the oversold condition we got in gold, that you can be recovering here up into some decent price levels in terms of, we're right now at 1781. I think you can be looking at something in maybe the 1840s on a decent bounce. And we'll see if it holds the low that we put in a week ago, because the big pattern that we're looking at, this big cup and handle from coming across from 2011, has got some pretty big upside potential if we can get a real spark underneath this market and get it going. So for now, short term, we're on the bullish side. for the next, call it $60, and let's see what happens when we get there.
A big heat wave is hitting the Canadian West. Vancouver might hit temperatures 40 Celsius, 104 Fahrenheit. What's that doing to energy prices?
Well, nat gas is really being the beneficiary out of this. Prices are up to $3.49 as far as natural gas is concerned, and it was back, 4 weeks ago that Commitment of Traders numbers came out on nat gas and showed that the specs had basically given up on natural gas. Their positions their net long positions were way down. The commercials were on the other side of the coin, and so here we are. And from the type of condition that natural gas was in on the COT numbers, we anticipated that the upside target here would be around 385. So we're maybe 60% of the way right now to that target. And if the weather wants to stay hot and dry like this in a large part of the continent, then that 385 number might be a little bit on the low side. The crude oil market, still like this one. It's part of the big 10-year cycle that we look at that had a bit of a hiccup last year because of COVID. But this leg on the upside, we had initial resistance at the 72 to 74 level, and if it punches through here, there's not much until we get up just a little over $100. Somewhere around 103 would be a pretty important level to look at for resistance. And as we pointed out in the last couple of months here, at this point in the rally, we had 2 time windows for a high. One was going to be in July, or it could stretch out as far as October. So here we are. We're pushing into the July window, and let's see if it gains some big upside momentum, which is typically how commodities like to finish their moves. I mean, just think back to what happened to the grains here a month ago, or what happened to lumber when it ran to 1700. You like to have those big exponential runs. So don't be surprised if one of those takes hold on the crude oil market.
Ross, thank you so much for the update.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at Charts by Ross. Coming up, Ed Steer next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm speaking with Ed Steer, founder of EdSteerGoldandSilver.com. He's also director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Merritt, British Columbia. Welcome back to the show, Ed. And I guess you're bracing for temperatures well over 100 degrees Fahrenheit, 40 plus Celsius.
Yes, we certainly are. I think it's 32 or 33 here right now, but tomorrow it's supposed to get up to 41 Celsius, which is, I don't care where you live, it's bloody hot for everybody. So I hope everybody stays cool this weekend.
Ed, you've seen 2 reports now on the commitment of traders when it comes to gold and silver. What do those reports tell us?
Well, it's the one that came out on Tuesday for Monday for the previous week showed a smallish increase in the commercial net short position in silver, which was just under 1,000 contracts, so it was rather insignificant. But there was a big improvement in gold. I think the commercial short position, the big 4-8 traders and the others reduced their short position by just under 14,000 contracts. And that was a larger number than both Ted Butler and I were expecting to see. So Monday's report was excellent all around.
How was the week for gold?
The week was fine. I'm just going to go over the COT report here for we just came out today, and we'll get into the gold and silver in a minute. But this week's report, of course, it showed huge position changes. There was a big improvement in the commercial net short position in silver and an equally large one in gold. The report was, as Ted said on the phone today, everything you could have hoped for, and puts the situation is from the futures market perspective on the COMEX very, very bullish. The big surprise was that the big 4 traders in gold actually added to their short positions by a small amount during the reporting week, which considering the fact that gold got hammered for what, $70, $80, $90 after the Fed news, we were somewhat surprised it didn't improve their short position more. It was the small traders. There's about 42 of them. Other than the big 8, once you get subtract out the big 8, there's about 42 traders left in the long category, and they were the ones that were the big buyers this week on the engineered price decline. So, but all in all, it was a very, very good COT report, and I was certainly happy to see the numbers. And as far as how was this week for gold and how was this week for silver? Both are you can include them in the same, is the fact that since we've had those engineered price declines after the Fed news last week, the prices have been held very closely in check. I've made a note in my column for the last 4 or 5 days they haven't allowed silver to close above $26 spot for 4 days in a row. I think that's changed today. They allowed to close it above $26, which on a Friday is rather surprising. But this week, all in all, it's been very quiet. We have July delivery month coming up in silver. Rollover volume is huge. Net volume isn't very much. So it was a very quiet week, and that's reflected in the stock indices as well. I don't want to get into the fine details of the COT report because most people really don't understand it. But this report that we got today, I was expecting far larger numbers in the improvements in the commercial net short positions in both silver and gold. They were great, and yes, the numbers are very bullish. But I must admit that on such a huge drop and obviously collusive engineered price decline in all 4 precious metals plus a few other things, that the improvements weren't bigger than they had. And what that says to me and to Ted as well is that despite how hard the commercial traders, commercial shorts shook the COMEX tree, this is absolutely the best they could do because, the engineered price declines were absolutely breathtaking in gold, silver, platinum, and palladium, engineered price declines that none of us have ever seen before. And so therefore I was expecting far bigger numbers than we got. And what that means basically is that if this is the best they can do, everybody that's in the non-commercial or small trader category that's net long against the commercials, they're not going to sell. They said, no, we're going to just dig our heels in, and this is the best we're going to do. We've sold our last long. We've put our last short position on. And if that's the case, then we've seen the bottom in the price. So it was very bullish from that perspective as well.
Did the U.S. dollar look like it had an effect on gold and silver this week?
I'll tell you something. Silver and gold want to rally regardless of what the dollar index is doing. It doesn't matter whether it's going up or going down. I consider that the dollar index is just as managed as everything else out there. Whether, as everybody knows, the equity markets are managed, interest rates are managed, the bond market is managed, precious metals are managed. The markets basically do what the algorithm, the traders want them to do. And most of the time, precious metals want to blow sky high, but once in a while they do use a dollar index rally, which I believe is, my opinion, they engineer themselves to smack prices lower and precious metal prices lower. And sometimes, like today, there was very little correlation at all when you look at the long term over the entire 24-hour period. So you can say there's a correlation, but there's only a correlation because they make it so.
China released a huge bunch of copper to help bring down prices a bit. Could you see them doing the same thing with their huge gold reserves?
Okay, well, that story's was floated out earlier this week that China was going to release some industrial metals out of its reserves, like copper, zinc, lead, whatever else. But there's no mention of gold, and I can tell you right now, there's no way that they're going to be selling any of their gold reserves to keep the prices down. These guys have been buyers for the last 15 years, and their reserves they're just untouchable. That's not going to happen at all.
Ed, can you tell us a bit about your newsletter and how people can subscribe?
Sure. I've been writing now for about 15 years on the net. My name is Ed Steer, S-T-E-E-R, and my column is Ed Steer's Gold and Silver Digest. They can Google it. Go onto my website. There's a sample column there. They can read it, and if that's the sort of information that interests them, they can sign up, and the freight is U.S. $100 per year, which at today's exchange rate works out to about $123 Canadian.
Ed, thank you so much for being on This Week in Money.
My pleasure, Jim.
My guest has been Ed Steer, founder of EdSteerGoldandSilver.com. He was speaking to us from Merritt, British Columbia. Coming up, Eric Haddock, next on This Week in Money.
Don't miss out. Stay informed. Receive the Housestreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the Housestreet.com weekly recap on our homepage at Housestreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Eric Haddock, CEO and president of InsideTrackTrading.com. He's speaking to us from the Chicago area. Eric, welcome back to This Week in Money.
Oh, well, thanks for having me back, Jim.
Before we get into the interview, Eric, can you tell us a bit about InsideTrackTrading.com and why Inside is spelt with two I's on the inside?
Well, we are a financial advisory and trading firm. Been around since the mid-90s, and the Inside is an acronym for the market sectors that were addressed right from the start, and it's pretty inclusive from indexes and inflation markets, stock indexes, the dollar and currencies, E for energy. So that was just an acronym in the beginning that kind of identified the key markets that were being focused on. It has expanded since then, but that still is the core of what we focus our analysis on. But we provide weekly and monthly advisory services and training in technical and cyclical analysis, educational material, so a whole host of products for traders to use in approaching the markets.
Eric, the 40-year cycle seems to closely coincide with your long-term outlook on interest rates. In 2019-2020, you discussed multi-year and multi-decade interest rate cycles bottoming in mid-2020. How does that intersect with the 40-year cycle, and does that reinforce your outlook for the competing currencies? And does Jerome Powell's recent statement corroborate that outlook?
Well, in order to answer that, I'd really have to give a quick rundown of what I have been discussing with you and with others for the last 6-7 years on this 40-year cycle. And it really is an uncanny cycle that I have documented back for hundreds of years in the U.S. and then in Europe. And one of the primary things that I really honed in on with that 40-year cycle is what I just termed currency wars. And for a 5 to 7 year period, every 40 years, you saw this steady and accelerating intensification of what I could only term as a currency war. And that was usually a battle, a heightening battle between paper or fiat currency and hard currency or metals. Most recently, digital currency has also been added into that mix. But going back to the founding of America and the Revolutionary War period and the introduction of the continental currency, which from the mid-1770s until 1781 was a failed experiment in fiat currency. And 40 years later, you had a battle over the rechartering of the National Bank and a whole host of economic issues that were centered around a currency battle that really culminated in 1821. And then 40 years later, you had a similar battle that was primarily focused on metals, where the government first started reducing the amount of silver in coins. And ultimately it led to the suspension of silver and then gold as payment. And that entire debacle culminated right around 1861. 40 years later, you had the battle for the gold standard, and what was a very famous speech by William Jennings Bryan on, I think it's called the Cross of Gold speech, and that was more a battle between gold standard versus silver standard in the different parts of the U.S. that favored each one. And that culminated in 1901 with the reintroduction of the gold standard. 40 years after that, you had another battle in the 30s and leading into early 40s that began with the confiscation and illegalization of gold and silver. And 40 years after that, in the 70s, leading into early 1980, you had a dramatic inflationary period, but really the key thing in there was the Jamaica Accord in 1976, which was, for all intents and purposes, a divorce decree between not only the U.S., but all of your Western monetary countries and gold. Basically putting in writing and formalizing the divorce between fiat currency and gold. And, anyone remembers the gold and silver markets back in the late 70s and early 80s, remembers what happened there. And interest rates were also greatly affected by that. So every 40 years, and it has usually culminated in the 1 year. So 1781, 1821, 1861, 1901, 1941, 1981 were when you saw the culmination of that 5 to 7 year currency battle. And in the mid-2010s, I was focusing on that and explaining multiple things I expected from 2016 to 2021. And one of the key things there was I thought that gold would enter a bull market, bottoming in late 2015, heading up ultimately into 2021. And once Bitcoin and digital currency kind of got more in the focus and forefront of traders, I discussed how that was actually making it a three-way battle between hard currency, digital currency, and fiat currency. But it was all focused on 2021 as a culmination to this phase of currency battles, not only in the U.S., but globally as well. And overlapping that, getting back to your question, overlapping that were also interest rate cycles, that you've had this 40-year cycle in interest rates that was forecasting a major bottom in mid-2020. And within that cycle, you had a extremely consistent, just an uncanny 4-year cycle that had adhered to a textbook cycle progression pattern. And I'd have to show you that in an illustration, but basically the cycle progression tool that I use, it shows how specific cycles will often alternate between 4 successive lows, and then after the fourth one, it enters a kind of a breakout market and then subsequently times 4 successive highs. And then it goes back down, accelerating down, and ultimately times 4 successive lows. But the point being, this 4-year cycle had times significant peaks in interest rates and lows in the bond and notes market in the 1990s and 2000s, and then bonds and notes, which are the inverse of the interest rates, saw multi-year peaks in mid-2012 and then mid-2016. And that 4-year cycle was the thing I was really keying off of, why my work was forecasting a major top in bonds and notes, a major bottom in interest rates for July 2020. And up till now, that's when we saw the bottom in rates, the peak in bonds and notes. And from that point, I've discussed why with a 4-year cycle like that, normally you'll see a 2 to 3 year move coming off of that. So if I was expecting a peak in bonds in mid-2020, that would look for a 2 to 3 year decline in bonds and a 2 to 3 year rise in interest rates following that mid-2020 peak in bonds. And then after a 2 to 3 year drop in bonds, rise in rates, then you'll see for the final year or so of that 4-year cycle, you'll see a reaction back up to a lower high in bonds and a higher low in interest rates. So the outlook has been for interest rates to move steadily higher from mid-2020 into mid-2022 to early 2023. We've got some monthly cycles that are starting to hone that a little bit and focus in on specific times. But you've seen the bond market start to hint at that from last July into March of this year. Then we've seen a little bit of a bounce leading into the current time frame. But just as I'm looking for a secondary top in bonds and low in rates, you have Jerome Powell come out last week and talk about how inflation is worse than he expected, that now you can start counting on a couple of interest rate hikes by the end of 2023. And all of this fundamental news and affirmation is just a perfect validation of what technical analysis and cycles have been projecting for interest rates for the last year and a half. And that's often how it works. The technicals, the beauty of technicals and cycles is that they give you timing ahead of events. Fundamentals usually kick in about a third of the way through a trend, through a cycle, and they end up affirming or confirming that what the technicals have already been showing. And I think that was just the perfect validation point when Powell came out last week with that news.
What kind of cycle is gold in right now?
Well, like I said, that's involved in that whole currency war cycle. And for 4 or 5 years now, I've been talking that I thought gold would move progressively higher into 2021. And then in late 2018, I updated that analysis and showed how the gold-silver index, the XAU index of mining shares, and related markets were showing that we should be entering a little bit more accelerated phase of that cycle, and that even back then in late 2018, those markets were telling me to look for a pair of significant peaks. First one in the third quarter of 2020, and then the second one in May of 2021. And this article, this report, I still send out to new subscribers, so you could see that 3 years ago this was very specifically documented and targeted. And gold and the XAU index rallied up into August of 2020, that third quarter 2020 peak. came back down, and then I was expecting a run-up into May, perhaps early June of 2021, which we got in those markets. So they're closely adhering to not only these multi-year cycles, this currency battle, but also to more contemporary weekly and monthly cycles that were focused on May, early June for a multi-month peak in gold and gold shares. And so that's where we are now. There is one additional weekly cycle that's coming into play in a couple months where I think that the XAU index, possibly the metals, that will be determined by the next week or two, and some specific technical indicators I use. But the point is that subsequent cycle could still see a higher highs in a couple of those precious metals related markets, but I'm expecting it to be more of a divergent peak where some of those markets set higher highs, others set lower highs, and that's often a strong validation of a topping phase. When you start to see that divergence in subsequent cycle peaks, it's giving you warning signs that each time you head into another, say, weekly or intermediate cycle peak, less and less of the overall market sector, less and less of the factors or the stocks or the individual metals within that sector are setting new highs. So it's showing you that kind of like the roller coaster analogy I use, where it's like the old wooden roller coaster with several cars in the train, where that last car has to hit its peak, even though all the other cars have peaked and started to point downward. It takes that last car hitting a peak before then you can see a significant and accelerated downward trend, that first big hill in a roller coaster. But they need to all be in sync, and the final markets need to have topped. So that's where these divergent successive cycle peaks are a clear warning sign, kind of a canary in the coal mine, or yellow flags being waved, however you want to term it. But that's where we're coming into with gold, that I expect a topping phase here in the coming months. And then there's 2 time frames out over the next 1 to 2 years where you could see some significant sell-offs in metals. And I think that's partially going to be linked to a recovery in the U.S. dollar, but also other factors that I've talked about.
What kind of a cycle are we seeing in crude?
Crude is also coming into a pretty significant cycle peak. It actually hit multi-year cycles in late 2018. So those peaks continue to be really the major resistance. But within that, taking it down to more multi-month and multi-week cycles, it's coming into June of this year where I think that we could see some significant highs, and then crude would be expected to start to turn down after that.
Commodity prices have skyrocketed. What kind of a cycle are they on? Things like copper, steel, lumber?
Well, they all fit into that overall currency war, interest rate, inflation-related cycle. Because when you have that currency war, particularly when fiat currency is struggling and showing weakness, you get commodity price inflation, and the late 70s into very early 80s are a perfect example of that. And so you have a lot of these commodity price inflation cycles also peaking, although there are specific ones like grains and a couple of other food commodities that I still see a subsequent peak in 2022. So you could get an initial sell-off from key cycles here. Some of the grain markets already peaked. Some of them are looking at July for a significant peak. Copper I've talked about. Some long-term cycles that come into play towards the end of this year. Lumber has already just recently come into some multi-year cycle highs. So you've got a mix of these cycles peaking throughout 2021, some going into 2022. So from an inflation standpoint, it's also what I was just talking about, where you get that series of successive highs, and you could call it divergence, but really what it is that certain commodities will still be setting new highs in successive cycle periods, while others have already seen their final peak, and often what they're doing is rebounding up to a lower high, then sell off, then rebound to another lower high, while those remaining inflationary markets are setting successive highs. So that's what I talk about with divergence. You can almost draw a downtrending trend line between the highs in the weaker market and an ascending or rising trend line between the highs of the final strong markets that are still setting successive highs. So I do think that we're entering into that time frame, but it could stretch into 2022 where commodity prices are going to be peaking, going through a bit of a topping phase, and then looking out a year or two is when you would expect more significant declines and more sustained declines once that topping process is complete.
Some of your discussions on the 40-year cycle have also included references to various solar cycles and even earthquake volcano cycles. Can you expound on that?
Yeah, one of the intriguing things that I've found in studying a lot of these cycles is often you will identify and document certain cycles that impact something like I was talking about the currency wars, and you might not even have a strong fundamental confirming reason why something like that might be. And for me, I don't need to have the why. I want to look at the what and the how and see, if I can capitalize on it, if I can prepare for it in whatever mode that might be. The why is kind of like it's the icing on the cake. And one of the things that was very intriguing to me after studying this 40-year cycle for a decade or so, and at the same time also studying solar cycles, things like the sunspot cycle, which is averages a little bit over 11 years from peak to peak and trough to trough in the solar storm sunspot cycle, but was the discovery of a broader overranging solar cycle that was one of the most significant, and I think they term it the conveyor belt of the sun cycle, and it details and it describes and shows how the polarity of sunspots and the movement of these storms on the sun's surface oscillate, and that what scientists and observers had found was that it was a very clear 40-year cycle that governs those peaks and that movement within the overall sunspot storm cycle. And so to me, it was just a perfect validation of this 40-year cycle on Earth, where you get some very unstable periods, and instability is often marked by economic struggles and things like fiat currency debacles. And not only did it identify and time those sociological and kind of mass civilization type cycles, but I also noticed a very significant coincidence with clusters and major peaks in earthquake and even more so volcanic cycles, which would not be completely unreasonable if you've got solar storm cycles going through a key 40-year cycle like that. You've got the geomagnetic storms that are projected out into space and often towards Earth, and you've got the impact that those storms have on Earth, starting from the poles on down, your auroras, the different major solar storms you've had through the centuries, and the destabilizing impact that has on not just surface of the Earth, but down into layers of the Earth and the magnetivity of Earth. And so it's not the least bit unexpected that things like magma movement and tectonic movement would also align with that same periodicity of movement, of surges. And so I have been looking at this time in the first half of the 2020s, expecting to see another cluster and an upsurge particularly in volcanic activity. And I detail and document this in several different reports I've done over the last 10, 15 years. But it's all at least loosely linked and maybe more closely linked than many people realize, together with all of these forms of destabilization socially and economically, and also geophysically.
What does that do when we have to plan the markets or anticipate financial things? When do we have to factor in things like geocosmic events?
I don't think that you can really factor in something like that on a more micro economic and investment basis. I think that you can certainly be aware of it, and if you see other signs, and this is where technical analysis to me is such a key and is so prescient in many ways, that the markets often reflect things like that before they occur. And it's not that the market, somehow knows exactly what's coming, but there are other signs and activities that start to reflect it, and one of the easy places to see it is in market activity on a chart. And so if you are aware of some of those possibilities on a big picture perspective, that might heighten your awareness a little bit as you're focusing on your investment activity. But I certainly would never recommend someone taking specific action based on such a broad-based and such a general cycle as that. I think there are times when the markets reveal to you that it's time to be more conservative and to pull back a little bit on your high-risk investments and speculation, and other times when you have a little bit more of a all-clear signal and you can be more aggressive in your investment. So if anything, I would say it's just a very general backdrop type of factor, and there has to be a lot more, and that's probably the biggest focus of my trading activity and of our entire advisory service, the focus on synergy. It's that coming together, that coinciding of multiple credible factors that then gives you enough confidence to start acting on it, not just looking at isolated events. That's even when I was talking about clusters of earthquakes and volcanoes. You get earthquakes and volcanoes all the time. You know, their earthquakes are going on every day, significant volcanoes multiple times every year. But if you clear that white noise and you start to look at the synergy of when you saw 3 and 4 and 5 major volcano eruptions over a few year period, and you start to look at just those times throughout history, you begin to see a little bit of a defined cycle there. And so it's synergy in all of these things that I think is the key to trading, to decision making in almost all of life.
2021 is also when you forecast the beginning of conflict or war cycles. Is that still the case?
Yes, I still am looking at that, and certainly see some subtle signs, as you often get in the early stages of something like that. But I discussed that as kind of a corollary or an offshoot of my 40-year cycle and the currency wars, that every other 40-year cycle, you also had very significant war cycles. First, or most recently, I was discussing that from a U.S. perspective, but then documenting it back to the 1200s in Europe and around the globe, but that some of your most significant conflicts and wars were on a very consistent 80-year cycle. And like I said, with where the U.S. is concerned, most recently you had the culmination of the Revolutionary War in 1781, and that timed to the onset or inception of the Civil War in 1861, even though the conflicts from the Bleeding Kansas or Bloody Kansas battles in the mid-1850s all the way up to 1861, that was something slowly building, but it was 1861 when that really kicked in the U.S. 80 years later was 1941 when the U.S. entered World War II, even though that had been going on for many years. And 2021 is when you've got the next phase of that cycle that stretches out for really from 2021 into at least 2025. So I'm definitely watching that as a one of those things that I'm keeping in the back of my mind, looking for other signs. You could certainly see growing tensions that you could trace back several years, really to the middle of the 2010s, growing tensions between the U.S. and Russia, U.S. and China, other countries in China, other countries in Russia, and even some other, not necessarily just those three big global players, but other conflicts that have been smoldering. And I expect to see some flaring up of that in the coming years.
Eric, with all this cycle information, what is an investor supposed to do right now?
A lot of that would depend on what that investor has been doing up to this point. When I have individuals try and write me and say, I'm in gold, but I wish I would have gotten out when that peak was forecast. What do I do now? Well, there's no way I can answer that accurately or even from a credible standpoint, because I have no idea what that investor, what his risk parameters are, what his goals are for that money, his or her, what what has gone on up to this point, what goes on beyond this point. There are certainly some general things I could say. One we've already been discussing, that investment like gold, I think, is coming into a significant peak. And so, those investors should have been in gold for the last 5-6 years. And now it's time to start paring back some of that as signals are generated on a multi-month or multi-week basis. I think that even things like we're talking about commodities and commodity inflation, that they've provided a great opportunity over the last couple of years, but you're probably coming into the final stages of those moves. So there are certainly shifts that should be taken over the next 3 to 6 months, but getting down to specifics, that's what I try to address in my publications with all the proper context, so that one general thing I say can't be taken out of context or misunderstood in the general theme or perspective of things. But I also think that even the stock market is entering into a time when another serious correction could be seen in the not too distant future. So there are some kind of pulling back or restraining type of actions that I think will be appropriate at specific times in the coming weeks and months. But like I said, that's the type of thing I want to be able to lay it out with all of the proper context so that everyone's on the same page and I'm not misunderstood with anything.
Eric, thank you so much for being on This Week in Money.
Thanks so much for having me back, Jim. It's been my pleasure.
My guest has been Eric Haddock, CEO and president of InsideTrackTrading.com. He was speaking to us from the Chicago area. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Ed Steer, and Eric Haddock. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@Housestreet.com. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Housestreet Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on Housestreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and president of American Manganese. Welcome back to the show, Larry.
Always great to be on the show, Jim.
Larry, your stock has been up the last few days. Is that a happy story?
Oh, yeah. It's, we're getting some buying coming in that has moved the stock up. We haven't had a press release in a couple of weeks, so that always takes the stock down, by the way, Jim. It seems that that brings the guys that want to bash the stock down out of the woodwork, and they just basically close us down on the day, and to try to make it look like we had a feeble release, which is not factual at all. But let's not go into that negative territory. It's the shares are starting to get recognized. Certainly, the European market is recognizing us a lot more. And I know there was a piece out on us today that came out of Europe, out of Germany for that matter. And those are the sorts of things we'd like to see, as third-party validation and saying things about the company that I like to hear. So I may or may not attach that to the podcast, but we certainly will if I can get it done in time, we will certainly attach that to the podcast. So other than that, there's been a few things that have happened that are off the wall, not necessarily directly what we do, but indirectly would be very beneficial to us. And one is the Russian war games off the coast of Hawaii, where they've got several ships and aircraft and all kinds of things. They're going to sink an aircraft carrier. They've been as close to Hawaii as 35 miles, although the main activity is going on out about 300 miles. So it's quite well funded. It's got a lot of things that you'd use in wartime. Planes, boats, destroyers, all those things to sink this one aircraft carrier. So now, what does that mean? Well, does it mean that Russia or Putin is basically saying flexing their muscles, or is it just that is it a subtle message to the U.S.? And then just yesterday, it was the day before, the British destroyer had a run-in with the Russians, and they fired quite a few warning shots over their bow and everything like that back in the Mediterranean. And none of that stuff hits the news. And again, so it tells me, is Putin flexing his muscles, or is this a warning that he can be on your doorstep in no time flat? Is this a warning that he can blockade the shipments of, for example, manganese or battery metals to the U.S., which has very little, no production of it, certainly no production of manganese. And remember that manganese is critical. It's not just for batteries. It's more critical for steel, making of steel. You can't make steel without it. The old saying, you can't make steel without manganese, and if you can't make steel, the world stops, is very true. And, the military certainly needs a lot of steel. The industry, manufacturing cars, bridges, anything like that, they need steel. And you can't make steel without manganese. So, that should be a wake-up call to the U.S., even though we are doing work on the Wendon stockpile, and that's with the DLA, and it's being funded by the DLA, and we've been shipping results to them, and we'll have news on that when it's approved to do so. So, we got a lot of things on the go, but we happen to be in the center of the storm, the way I see it, with manganese and the production of manganese metal or dioxide. And, we're just in the center of all of that. We're certainly well known by the U.S. government, and not only in the manganese sector, but we also have that collaboration going on with the Department of Energy and the Critical Materials Institute. So, we're in the right place at the right time, and I think that anything can ignite the stock, because we are, even though we've had a lot of publications out there. We've been published in Bloomberg and Reuters and all those magazines. We don't seem to have quite the recognition I thought we would have by this time, but I think that picture is changing rapidly. And, we've worked hard to come up with a solution that is just a straight line from cathode to cathode, which means that by the time we get through recycling cathode material, at the end of the line, it can go directly into a battery. And so we sidestep a lot of transportation, a lot of cross-border stuff where you have to send your stuff to a battery not a battery manufacturer, but a cathode manufacturer, and most of this chemical work is done in China. You know, China's really tightened their grip on everything that the free world needs, and that's not a good thing because China is, you know, they could certainly flex their muscles at any time too. So, you know, it's but, you know, for the shareholders and all that, I think that we're in a perfect position to help out and to assist and to, you know, build supplies of manganese, to build up recycling plants. I'd like to say specifically in the U.S., but we seem to get romanced more by Europe, who's much more aggressive on that. And it's a nice place to be. It's not exactly like we are a forgotten hero. I mean, the fact is that we've had a lot of stuff published on us. I remember when we did the economic standard publications, we totaled about 250,000 reviews on those, and we're getting ready to publish again in the economic standard. And you know, so it depends on the mood and the way the people feel, and if they're attracted to what we have to say, how many views we get then. But I'm betting on the higher side of 250,000. So it's not like we're you know, sitting on our hands here watching the sun dry the lawns out. It's more like you know, it's fighting off the heat and keeping our nose to the grindstone. So yeah, I'm optimistic, very optimistic about our future. And I did say in the last podcast last week that we would that we have a V-shaped recovery, and that is still going on. If you look at the charts, you'll see that. And I think that you know, we'll surpass old highs, and because why wouldn't I? I mean, I think we've got the answer to a problem that is only going to get larger and larger when most of these batteries go into landfills and smelters. It's you know, if we can solve that problem, then I think we've got the big advantage. And so you know, and this is all my opinions, Jim. It's not like it's written in stone or anything like that, but as a CEO, I have opinions, and I think we're on the right track, and I think we're moving swiftly to close any gaps.
Larry, what's the latest on your pilot plant?
Well, the pilot plant is working. We're waiting for results. Sometimes we have to get third-party verifications, and especially when it comes to the back end of our pilot plant, where the morphology is concerned, and you know, we have to send that out for X-ray photographing and everything like that to arm's length. In this case, it would be the University of BC, and so we have to wait till they can turn the results around so we can make an announcement. And as far as the manganese stuff goes, we have to send out verifications on the level of purity and everything else that we're doing with the manganese. So there hasn't been any news. It's not that there's not work going on, and there will be news. But yeah, I'm glad you asked that question. Oh, and as on the ending here, I'd like just like to say that I saw some headlines today where Panasonic had sold their position of, I think it was a 1.1 or 1.4 million shares of Tesla that they paid $21 for back in 2010. So, you know, that's a tremendous amount of money suddenly going back into Panasonic. It didn't hurt the Tesla thing at all. And, you know, so Panasonic, you know, will be looking at building another factory here soon on their own.
Larry, for people new to American Manganese, what's the company all about?
American Manganese is a critical metals company that developed a patented process for the treatment of very low grades of manganese, 2 to 3%, to make electrolytic manganese metal or electrolytic manganese dioxide. We completed a pre-feasibility study. It was a race to the bottom. The price was going down. At the same time, we were getting results from the pre-feasibility study to the point where it would have taken 11 years to repay $500,000 investment. I think it was $480,000 or something. Not $500,000, $500 million investment. I think it was around $480 million. But luckily, we moved on to looking at recycling the cathode materials and lithium-ion batteries. And, our proof of concept showed that we were on the right path. And since then, we've spent $10 or $11 million proving up that concept, filing 2 patents and applications in 7 other countries, one of which has already approved us, and that's Korea. So that was a lifeline to the company and also certainly to the environment, because that was foremost in our mind. It was when we were working on manganese. We had a dry tailings, and we had sufficient use of water as you could get where you're out in the Arizona desert, where you lose a lot to evaporation and everything like that, but we didn't use any crystallization. And so we maintained as much water in the circuit as we could, and we ended up maybe using a third that we would have if we used a wet process of tailings. So that was the gist of all that.
Larry, how can people get more information about American Manganese, and where are you traded?
Okay, American Manganese has a website called AmericanManganeseInc.com that is very transparent, has all the results and everything that we've had on our process. And they were traded in the Venture Exchange, the Toronto Venture Exchange under the symbol AMY. We're traded in the U.S. under QB board under the symbol AMYZF. And we're traded in Frankfurt under the symbol of 2AM.
Larry, thank you so much for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on June 25th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at Housestreet.com. Company Showcase is a production of Housestreet Media Incorporated.